What happens at expiration with cash settlement? Have you ever wondered what really goes down when options expire with cash settlement? Let's break it down step by step. At expiration, cash-settled options do not requiring the actual delivery of the underlying asset. Instead, traders receive a cash amount that reflects the difference between the option's strike price and the final settlement value of the underlying index or asset. This process kicks in only if the option is in the money, meaning it has intrinsic value at the time of expiration. First, let's talk about the expiration date and exercise. Cash-settled options usually follow European-style expirations. This means they can only be exercised on the expiration date itself. On that day, the option's value is determined based on the official closing or settlement price of the underlying index or asset. If the option is in the money by any amount, it automatically gets exercised and settled in cash. Next, how is the cash settlement amount calculated? The cash settlement amount is the difference between the option's strike price and the final settlement value of the underlying index or asset, multiplied by the contract size. For a call option, if the final settlement value is above the strike price, the holder receives the positive difference in cash. For a put option, if the final settlement value is below the strike price, the holder also receives the positive difference in cash. If the option expires out of the money, it simply expires worthless, and no cash settlement occurs. One of the key benefits of cash settlement is that there is no physical delivery involved. Unlike equity options, where exercising might mean receiving shares, cash-settled options avoid the hassle of transferring securities. This is especially useful for index options, where the underlying is a collection of stocks, making physical delivery impractical. Now, let's discuss the automatic exercise and broker procedures. The Options Clearing Corporation mandates that in-the-money options are automatically exercised at expiration, typically if they are in-the-money by at least 1 cent. For cash-settled options, this means the holder automatically receives the cash amount without needing to take any action. However, brokers may have specific cut-off times and might charge fees if positions are not closed before expiration. Lastly, what does this mean for traders? If you hold cash-settled options, your profit or loss will be realized in cash rather than shares at expiration. This simplifies the settlement process and eliminates the need to manage stock positions. However, it is essential to be prepared for the financial impact of the settlement, as gains or losses are realized immediately in cash terms. In essence, at expiration, cash-settled options lead to a cash payment that reflects the option's intrinsic value based on the final settlement price of the underlying. There is no transfer of shares, and the process is automatic for in-the-money options, making it a streamlined method for settling index options and other non-physical underlying options in stock trading.